Good morning, Saurabh, and good evening to others as well. So, first of all, on behalf of IvyCap Ventures and Bharat Innovates, I would like to welcome and thank you, Saurabh, for taking time to join us today and sharing your expertise with us. Thanks to all of you. I know if it is kind of in India, you're in the afternoon, kind of 1:30. Hope you had lunch. And because this is going to be very exciting and interactive session, because when I spoke to Saurabh had mentioned, unlike going to be a presentation and then we take 15 minutes of Q&A later, this is going to be a very active workshop kind of model and one of the most important session today. And there is no one better than Saurabh to take this. Saurabh has a decade of experience in deep tech investing, research, venture building, and investing experience, and especially from the Europe market, from the Paris, France market. So, I would like to welcome. So, today's session is more focused on understanding international investor evaluation framework, governance, how do you speak with the investor, how do you interact with investors, etc. Yeah, over to you, Saurabh. I'm very, very looking forward to having an amazing session with you.
Thank you, Ananya. Thank you, Bhavani. And thank you, IvyCap. Thank you, Bharat Innovates. Hello, everyone. Very quick introduction. After Ananya's introduction, I just want to take 1 minute of saying who I am and where I'm coming from. So I'm originally from Jaipur in Rajasthan, and I somehow reached IIT Bombay. From there, I moved on to Paris to do my PhD in genetics, followed that with a brief postdoc. Realized that the change I want to see is not in academia, and I do not want to see my thesis staying in some library for the rest of my life. So I moved on to management with a management degree, worked for a couple of startups, worked for corporate venture building with Hello Tomorrow and BCG, where I actually led the deep tech strategy for a number of governments as well. From there, I moved on and I was poached by a family office consortium advisory to a number of family offices called Sagana, uh, approximately 4.5 years ago. And at the same time, I wear a second hat for a fund called Circulate Capital. That is a 550 AUM fund investing in circularity. So on the Circulate Capital side, I invest in circularity based ventures. On Sagana side, I invest in anything deep tech. From Sagana side, we are invested in approximately 25 funds, and we are invested in, how do I say, over 80 direct investments, and a lot of them are in India, by the way. So I have a context of investing in Indian market as well as the European market as well as the US market. And that's what I want to bring today. I want the session to be extremely interactive. And what I have done is what any decent investor in deep tech would do. I have divided the session into three parts: technology, value proposition, or business model, depending on what stage you are at. If you're really early, it's value proposition. If you are later stages, it's business model. And then team governance, rights, let's say communication style, and so on and so on. What I'll do is I'll end each session with a case study, and all the case studies are my portfolio companies. So you get a real life view of what we are talking about here. And the way I want to run this session is that I have one slide, one message, and it would be great that when I put that slide on, you guys open your mics and start speaking. Talk about it. If you have something to add, if you have a question to ask, talk about it. I will add 1 or 2 line messages on each slide till I reach the case study, because this is where I want the discussion to be really rigorous. So it's not me, it's me walking you through the journey you're about to take. This is how I want it to be. I hope that works. Um, Again, starting with the fact that investors anywhere, if they are decent investors, they should look at all the aspects of a venture, and this is what we have done. What I will add is how you being in India can be to your advantage. You can use that to your advantage. That's the most important part. So if you're early stage venture or late stage venture, let's depending on if specifically if you're deep tech venture, technology is one of the most crucial elements out of the three: technology, team, business model. Okay. What any investor would look at is if your technology is a step up. Is it a 2x step up or is it a 10x step up? What does it mean by 2x or 10x? If it's a 2x step up, is it a venture case? Anybody who wants to open up and Mike, yes or no would be enough as well. Or even in the chat.
No, no.
Absolutely, it's not. Because if it's a 2x step up, you can go to a bank, get a loan, and start a business, and that will work very well. A venture case means an investor like me wants to invest in companies that will give me 10x of my returns. What happens eventually is a different thing. That's where the risk features in. But 10x is what we are looking for. So when you present to any investor, specifically outside India, you have to be very clear how your technology can bring 10x returns, let's say in a set amount of time. It can be 5 years, it can be 6 years, it can be 10 years, depending on the what type of fund you're applying to. So you have to keep in mind who you are talking to, who you're applying to. When you are talking about technology, let's say you have a certain technology, and I will come to my case study. Uh, and you want to build it up, but then the one of the questions people ask is like, okay, let's say if I have a pharma technology, medtech technology, I will ask like, okay, there are so many big medtech companies. If they have the resources and they have all the resources, why can't they do it? And how can you compete with them? And it's one of the most important things that you should think about when you're making a startup. That philosophy. Again, open the mic, speak. I have no qualms about anything. So just open or write in the chat. I have both open.
Startup scale pretty fast, and if in the big corporate, it need to be take approval from everyone.
Absolutely, absolutely. So, how many of you have heard about DBTL? And I will not wait for the answer. DBTL is design, build, test, learn. This is a cycle that startups can do a lot faster as compared to corporates. So, the speed is what makes the startups a lot better than corporate. So, what corporate would achieve, let's say, in 2 to 3 years, that startups might be able to achieve with a lot of smaller team, with a lot of smaller resources within 1 year. So it's almost the Fed stats is almost 3x to 10x speed up in a venture. And this is what leads to a lot more performance. And this is exactly what startups win at. And that's what you should be very clear to communicate this part, how you are better than the existing corporates in terms of your technology. If your innovation is scientifically novel or not, it means that you have IP or not. It means that what you're doing, can it be easily replicated or not, most importantly. And if it can be easily replicated, of course, it's not commercially defensible. For a deep tech venture builder or for a deep tech, let's say, investor, if you are not scientifically novel, if you are not 10x above the current technology, the innovation is not defensible. IP, if it is filed or not, and if it is filed, at what stage are you at? And all of this information has to be in the data room. The data room has to be structured in a way that your technology comes across extremely clearly, including the value chain of it. What TRL level you are at? Are you in between TRL 1 to 3? Are you in TRL 3 to 6? Are you between 6 to 9? What does it mean, TRL? TRL is technology readiness level. Are you at pilot stage? Are you at lab stage? Are you about to enter the commercial stage? Are you already selling and generating revenues? So if you're selling and already generating revenues, it's commercialization, which is TRL 8 and 9. If you are still in the lab, it's TRL 1 and is TRL 3 and 4. If you are still at proof of concept stage even earlier, it's TRL 1 to 2. And that is extremely important to say where you are at, because this is how you will attract the right investor. For instance, me, I'm a kind of investor that invest in between TL 5 to 7. If the companies that are coming to me at TL 1 to 3, those are not relevant for me. If they are later stage, they're also not relevant for me because I can add the most value in between 5 to 6. Same thing. If you are early stage and you are at a place where you already have pilots, let's say you are having 3 or 4 pilots, somebody wants to say something, I'm happy to hear. I heard someone's mic open. All right.
Sorry, I've muted.
Uh, if you are early stage it's extremely important to showcase that you are having pilots. If you have pilots, it brings credibility to your company. What does credibility bring? Credibility brings investments. If you already have customers that are buying things from you, it's extremely important to showcase it. If you have industrial partners for a specific value chain of your technology, that's important to showcase. Again, all of this should be extremely clear in your technology stack. The more information you provide on these things, the more confidence it brings for the investor. Because as an investor, they are not in the day-to-day life with you. They are only seeing this for the first time. They will come do a site visit. All of this is a later thing. But to bring the first confidence, it's important to showcase like, look, we have this and this is already being tested by 3 pilots. Or we have this and we already have an industrial partner for this. It's extremely important to actually showcase the challenges that you will have. Can anybody tell me why this is actually better to showcase that you will have challenges than to showcase like everything is gonna go smooth?
Uh, Hello.
Yeah, I can hear you.
Yeah, so basically, you give a complete detailed picture of what you are in, so that if the investor is someone who is not a deep tech investor, he can take a choice that he if he wants to invest or no, or else something
I
like
I
that.
I love the ethics. I love the ethics. Whoever is speaking, I love your ethics. But it goes further beyond. It shows as a founder, you're able to you have the vision to see the challenges that are going to come because only and only if you're recognizing able to recognize the gap, you're able to mediate it in time. If the gap is a surprise for you, you're not able to mediate in time. So imagine like if I'm a venture that suddenly I haven't seen forward as a challenge, and then I see the challenge when I have runway remaining of only 4 months, but to solve the challenge I need a runway of 7 to 8 months. Yeah, that's when investors freak out. That's when investors know that you do not have the vision. So to add additional capital or to give you the ref checks that you require in future, they will be apprehensive. And that's where it becomes important. So any investor, any decent investor would actually go for a founder who can see a challenge way in advance. So what are the challenges in your deployment is actually good to showcase. How easy is your technology to be adopted? Is it CapEx heavy? Is it OpEx heavy? Again, this selects the kind of right investors for you. If anybody wants to say, speak anything, just raise your hand, speak. Do not raise your hand, directly speak. Open the mic and speak. But this is exactly the point that I want to make even stronger in context of Indian scenario. And this is again the case study that I have selected for this part of the deck. So we have to keep in mind CapEx versus OpEx, capital efficiency. Does you being based in India increases your capital efficiency? Can anyone explain what is capital efficiency? Okay. So capital efficiency is what a startup can achieve in a set period of time with a limited capital. And let's say, would this capital efficiency be different for the same startup if they are based in US or if they are based in India? So within the same time frame, within the same resource time, and with the same resources, can a startup achieve bigger milestones? And that is what defines capital efficiency.
Is this capital efficiencies depend on the how many capital resources you have, or it is something else?
It is exactly that. But let's say if I have a venture that has raised 6 million in total, 6 million USD, all my numbers are in USD, has 6 million in total. And in India, they achieve a benchmark of, let's say, going to a clinical trial. Let's say this is a clinical company.
Mm.
And same kind of a startup in US has raised 60 million, and then they are achieving clinical trial one. Which startup do you think has a better capital efficiency?
Uh, Indian one.
Yeah, absolutely. And that is one of your strongest suits. When you're coming to France, when you're coming to US, talk about capital efficiency, talk about how being at two different places or how you being in India is actually helpful for the investor, because the investor has put less amount of money. They will get a lot more X on their investment. Imagine someone who has raised 60 million, their valuation would also be about 200 million. Someone who has raised 6 million, their valuation is 20 million, 25 million, let's say, okay, considering the same type of dilution in both the scenarios. And if the startup is now sold at 1 billion, one is getting 4x, another one is getting 40x. That is one of the biggest things you should very clearly communicate. If you have it, make it your strength. That you being in India is the biggest strength that you have. So I'm going a little bit more detail on the same part. How can you increase capital efficiency? The way you explain it is by smart delegation of resources. You are using India for R&D or engineering, but you are using US and EU for commercialization, or let's say for fundraising. And that improves immediately that immediately shows how smart you are with capital. Which ties in again to company's execution model. What is your runway? What is your burn? What are your revenues? What is the pathway to profitability in a limited set amount of capital? What is the runway that you can achieve? Let's say in 6 million, if you have a model which is diversified between Europe and India or US and India, you achieve a runway of 2 years. If you're only in US or Europe, you achieve a runway of 6 months. What is your burn? Because you are using human resources based in India, you are not paying the same salaries as compared to someone based in Switzerland. Just to give you an idea, let's say you have a scientific hire. In India, you might have to pay 30 LPA, and for the same hire in Switzerland, you might have to pay 150 LPA. And these are all your strengths. You showcase how your runway is a lot longer, your burn is a lot lower, because you have all of this talent available in India, which can do the same thing, but at a lot lower capital, at a lot lower expense. So your overall costs are lower. So your pathway to profitability with the same amount of capital, imagine you have 60 million that a startup in US is raising, you have that in India, your pathway to profitability will be a lot faster. And these are the things that investors care about. So extremely important to mention those things. I want to look at the time before I get into this case study. Okay, we are almost at 21. So 21 minutes into the thing. Okay, so this is one of my portfolio companies called Helix. What do? They actually make somatic gene editing therapy for kidney diseases. And a very particular type of kidney disease called ADKPD. Okay, what it is, we are not going to go into it. Why are they different? So any gene therapy requires basically any gene therapy with the latest model, which is CRISPR gene therapy, not the viral vectors, the CRISPR gene therapy, requires a delivery vehicle. Why is a delivery vehicle required? Because gene therapies cannot be done to the entire body. If they are done to the entire body, your germline is affected. If your germline is affected, it passes on to your children, which is not allowed ethically by the gene generating consortiums. So what the startups have to do is they have to select or they have to target the gene therapy to a specific organ, in this case to kidney. How do they do it? They have a delivery vehicle. If you have heard of, if you know what BioNTech and Moderna did for mRNA vaccines for COVID, their innovation was as much as in the mRNA, as much as in the delivery vehicle. So the delivery vehicle was very important for them. Same case here. But how does having a delivery vehicle de-risk this company? Let's talk about technology now. And it's not about pharma, it's not about clinical trials, it's not about anything. What I'm showing you is that they have something which is very high up in the value chain. How does having something high up in the value chain de-risk the technology? And this is something that you should talk about. So anyone who wants to just say things. Again, this is relevant for any technology, not just this. And I have simplified it in the manner that if you have a value chain, you are doing something here, but you have also something above in the value chain, up in the value chain. How does this will de-risk the entire value chain? Okay.
Can you go to the point of how can your technology be adopted? Like
Absolutely.
you were mentioning about CapEx and OpEx, so this is a different version of that.
Absolutely. So imagine this startup is making a kidney disease thing, okay, and a very specific kidney disease. But their delivery vehicle is specific to kidney, and there are a number of other kidney indications, number of other kidney diseases. Imagine another startup making only the gene therapy, but they have no delivery vehicle. What they will do, they will come to Helix, like, can we use a delivery vehicle? So while they have their own clinical pipeline, or while they have their own product that they're focused on, they can outsource or they can license a part of their product without affecting their main pipeline. And by doing so, they are de-risking, they are generating additional revenues while they are working on their own thing. The opposite scenario would be that they have their delivery vehicle, they have their gene therapy target, they do not do anything about it, they just focus on their thing. They will have no revenues in 7 to 8 years till they reach that maturity to sell this in the market. But what if they have something upstream that other players in the market can use as well? So if you have something that you can already license out, showcase that. Showcase that you are able to de-risk your risky business idea in a deep tech. The more easily you can showcase, like, look, we are focused on this, but we can have additional revenue generations by not doing much. And that's extremely important. Second part, is your technology important outside India, or is it only focused on India? If you showcase something that is only focused on India, any investor who is based in US or Europe might have apprehensions. It can still be valuable. Do not get me wrong, India is a huge market. But imagine there's an investor that is specifically looking for how would it impact European population, or how would the impact be translated in US, which is what is going on at the moment in terms of geopolitics. So if you can showcase that their technology is highly relevant outside India, which in this case it is, because kidney diseases are a global phenomenon, it's not just Indian, it will immediately attract foreign investors. In case of Helix, a large Swiss family office. But just to give you an idea, a very good idea, Helix has raised less than 6 million in total, and it's at the same milestone as compared to companies that have raised 60 million to 200 million. Helix has a US headquarter, and Helix's operational headquarters are in US, but the operational headquarters are in India. All the labs are in Hyderabad, but the business headquarters are in US, which is what helped them do this, navigate this. And this can clearly be your strength. Any questions before we move forward and go to the next stage?
So
All right.
question comes
Yeah.
up again and again, wherein when you're looking at foreign investors, that they would prefer to have companies who are closer to them geographically. So I think it's an ideological question. Like, what should you do if you
It's a good
don't want
question.
to flip to, US or the likes?
So the reason I gave the example of Helix is exactly this. If you can have a business headquarter, let's say someone or a sales team, let's say, or business team located in US or Europe, and while the operational team is located in India, they are okay with it because the startup is located close to them. A part of the startup is located close to them. And people who are not okay with it are not your ideal investor. You have to also be on that page, like, okay, if this is not the right person, this is not the right person. The other part is, what if you do not have the headquarters in Europe or US? You are only located in India. In that case, the way you can navigate is by having customers in US and India. If you can show that, look, our customers are here and we are generating revenues, or we are having pilots here, and you can visit those sites because we are having pilots there, or we can put you in touch with the person from the corporate or from the pilot that is there, and you can talk to them. That already de-risk a lot of it. But the easiest way is to have HQ in Europe or US, and then having operational HQs in India. But if you do not have it, the second best way is to find customers, partners, commercialization pathways in Europe and US, finding the market and then showcasing that, look, we are relevant for those places as well. I do not know if I answered your question directly or not, but this is the best way I could.
Does it help to have a subsidiary outside? Does that
Very
create more
much.
comfort?
Very much. But the thing is, if you're HQ'd in India and you have subsidiary, It's less helpful as compared to if you're HQ'd in EU or Europe, EU or US, and subsidiary in India. So it depends what you are doing exactly, and it depends how you are set up. So some investors, for instance, can only invest in EU or US startups. If that's the case, having a subsidiary does not really help much. It's the HQ that matters. But if it's a investor that can invest anywhere, but they just want to see you being located close to them, then the subsidiary helps perfectly well. So again, it depends on who you're targeting, what your model is, and how you're working it out. But point in case that all of these can work depending on how rigorous you are and how you form your story. All right. Second part, business model value proposition. So I covered already parts of that in the technology part, but I want to again end this section with a portfolio company of mine. Your problem statement, is it global or local? That's very important in a business model. If you are pitching to, let's say, investors based in Europe or US, exactly the point I made earlier. So, is it even a venture case? 2x versus 10x in the technology tying up here. So you see a lot of things actually tie up, and the more your story is tied up, the better it is. Okay. Has the company thought of end customers' return of investment? What are end consumers? Anyone who can explain me what would be the end consumer, and even if they are not your customers, should you think about it? Okay, let me give an example. So I have a portfolio company that recycles rare earth elements, and rare earth elements are not used in chips, but they make machines that make the chips. Should this company think of how this will affect the price of the chips or not? Or they should only think about it's okay, we just recycle the rare earth and it's okay, it's fine. No, they should think of the final material. If the final material price is increasing, the adoption for the final consumer is increasing. If the adoption for the final consumer is increasing, it's putting pressure on the company that is making chips. If the chips adoption is decreasing, it's putting pressure on the companies that are making machines that make the chips, which in turn is putting pressure on the machines that make the chips. And the end machines are what uses rare earth elements, let's say. So they decrease their sales by not looking at the end consumer. So the entire value chain should be looked at when you are making a business model. Yes, your immediate business model should be the only your customer, how you are selling it to, and what you are selling it to. But when you explain a business model to an investor, if you have looked at the entire value chain, the investor understands, you understand how the market is run, you understand the value chain, you understand the leverage points in that value chain, and you understand where you stand in that value chain. So yes, segmented value chains are important for your financials, but the overall value chain is what gives you a better selling point. So if you want to be a better salesman, whether it's to the investor or whether it's to your customer, explain by looking at the entire value chain. Showcase that you can make money for all across the value chain for all the players, and this is when you are in business very fast. The faster you can do it, the easier you can sell. I will showcase this with my case study again, by the way. Is your business model repeatable, or is it a consulting business model, which let's say repeatable means like, okay, you showcase you deliver one time, but it's required over and over again, so that it means that you keep selling. Imagine you already consulted the same the partner once, or your stakeholder once, and since they have all your consulting material, they do not require you anymore. You need to find a new customer. So it depends what kind of business model you have. Is it a repeatable, recurring business model or not? Only a repeatable, recurring business model is a venture case, or investors like me are interested in repeatable business cases. You need to think in terms of sales cycles. They are long or small. If they are short sales cycles, they are long sales cycle. Your feedstock. Can you procure your feedstock in a short time, or you can procure your feedstock in a long? You need longer timelines. Now, let me give you an example on the procurement timelines. In terms of the current scenario, what is happening at the Strait of Hormuz? Let's say if I'm a plastic recycling company, okay, and I am actually procuring plastic within a time frame of 2 to 3 months, okay, and I'm recycling the plastic, okay, but in turn plastic is made by oil. Can anyone explain how would I be impacted? Oil is blocked, by the way, because of a Strait of Hormuz blocking. So you have less oil coming in India, which means less plastic is being made, which means
The cost increases, the value chain is disrupted.
The
yeah,
recycled plastic becomes more precious.
absolutely. So what happens is this: plastic is dirt cheap, and recycled plastic is has to compete with the petroleum-based plastic. And when you're competing with petroleum-based plastic directly, the virgin plastic, they say, let's say virgin plastic versus recycled plastic. Now, recycled plastic is very hard to sell because the virgin plastic is so much easily available. But once the petroleum value chain is obstructed, you have a lot of plastic waste available, which means you can recycle rather easily, but you have no oil coming in, which means the virgin cost is increasing or virgin price is increasing. Which means that if you have a plastic recycling as a business, this is the best time for you because you can command a higher price. You have so much demand because normally demand for plastic is always there, and the best time for you to be adopted. So what are your adoption barriers? What are your procurement timelines? What are the leverage points? It goes back to having a value chain. All of these things are fitting in the value chain part, every single one of them. And this is why it's extremely important to look at your value chain, look at it from feedstock point of view, look at it from sales cycle point of view, look at it from adoption point of view, look at it from repeatable point of view, look at it from end consumers point of view. Every single point, your value chain. Where does your value chain assimilate? Which means what is your first market? You are based in India, great. But is your first market US, Europe, or India, or Indonesia? And that is extremely important for an investor to understand because let's say if I want your value chain to be in US and I'm an investor based in US, I would like your market to be in US. So it's very important to communicate that part. Extremely important. Same thing, which we have talked about multiple times. Fundraising, are you suitable for US, Europe? Depending on the subsidiaries, depending on where you're HQ, depending on your business model, depending on your market. Data room, extremely important. So yes, why I included data room in business model proposition is because a number of companies either talk too much about the team or talk too much about the technology or talk too much about the value proposition. It all has to be balanced. It all has to be structured. It all has to be layered. If I cannot find in your data room easily the IP, I'm already like, okay, you do not have an IP. So can I find it easily? Do you have a table where I can just click and I can reach the right data room place? If I'm having issues finding something, can I just write to you and you send me the link? Or you would be like, oh, it's already in the data room. So it also depends on communication. Eh, The easier you make it for an investor to find resources or find information, the easier it is for an investor to take a case and present it to their investment committee. So always think it from an investor's perspective. How can you make it easier for an investor? Yes, a lot of times it's frustrating. Yes, a lot of time you're like, okay, but all the information is there. Why can't they see it? This is what it is. Your job is to make everything easier for the investor. This is what you're coming for. Your job is to get the investment. That's what you're looking at. Preparation. Always prepare. Always think of the worst case scenarios. Always think of the cushions. Always keep your patience. And the only way you can keep your patience during presenting something to someone is by preparation. Prepare. Do not go to a meeting unprepared. Never go to a meeting unprepared. Irrespective of what they show in movies or Shark Tanks, always go prepared. Uh, let's say I'm invested in a company already. What comes next? What is the governance? That depends on what stage I have invested the company in. Normally, when I invest in a company, I like to have three things: a board seat. What does a board seat mean? That any strategic decision that will be carried in future for the company, I will have a vote on it. Extremely important. And investors in EU and US take that extremely sincerely. So depending on the ticket size that they're doing, you present them a board observer seat or a board seat. If they have none of this, there's another important thing that you can present, and people are actually very happy to see it. Information rights. Can I send you an email and ask for an information, a particular information, and would you send it to me or not? And by having that legally, it means that yes, I can ask you something and you have to answer me on that part. If I mean normally if you have the board seat, board observer seats, you have information rights. Normally it's there. But let's say an investor does not have the ticket size, present them an information right that okay, look, if you come in, you have information right. And this is a very important part, how you manage investor relationship. Do you send regular updates? Do you have quarterly calls? Do you have monthly calls? Do you have quarterly board meetings? If you have quarterly board meetings, are you sending the agenda in advance? Do you have board materials, what you're going to discuss in that board meeting 1 or 2 weeks in advance? Or are you sending it 24 hours in advance? All of this makes your reputation. All of this makes an investor say to other investors, more readily like invest in this venture. And yes, any investor would say that if I'm already invested in a startup, I'll be like, yes, you should invest. But if you maintain that relationship that warmly, I will actually go out of my turn and go reach out to other investors and say like, oh my God, look, this is a company that you should invest in. I will reach out to my friends like saying like, this is where you should invest in. Reputation matters. How do you make reputation? By managing the relationship. How do you manage relationship? By having a very high performance governance structure in a venture. How can you do it? By having board material sent on the right time, by having information rights, and a number of those things that we just discussed. Example. This is another example of my company. It's not based in India. It's a US-based company called Cyclic Materials. Extremely strategic at the moment because AI is exploding. What does AI need? AI need more chips. What do chips need? Chips need to be manufactured by lithography machines. How lithography machines are made is by a single company on this planet called ASML. What does ASML require? Magnets. What does magnets require? Rare earth elements. Where are rare earth elements coming from? Only and only China. But where they are present on all the magnets. So what if you can recycle from these magnets? Any heavy duty magnet have rare earth elements in them. And this is exactly what Cyclic does. So you can imagine at this moment in time, in this geopolitics, Cyclic became extremely important. It is a venture case. It has presented a value chain compression. We have information rights on the company, and we have monthly and quarterly calls with the company, which means that we are extremely in touch with them, which means that when Cyclic will raise its next round, I'll be very happy to propose Cyclic to my investor friends. To showcase what does a value chain mean, this is what a value chain means, and this is how you should look at. Cyclic sells rare earth elements, this here, but they are thinking in terms of chips. If you want to keep the price of the chips low end, you need the price of the rare earth low end. How do you do it? By recycling, or you need to actually keep the availability of rare earths easily. If China blockades rare earths are blockaded, no more large magnets, chips are not so many, and so AI infrastructure stalls, which means anything modern stalls. So far in the value chain, and yet they make sure that everything runs smoothly by having only one leverage point. And that's how you should explain it to the investors. You look at something which is very big, but then you look at where your value chain, where your leverage point is. Any questions at this end before I go to the next part, which is rather easier than the first two parts?
Can you just explain me this part once again? Like, what if China blocks? So there is some hindrance, right? So we are not able to do anything. Then how do you explain this to the investors? Because this is the high risk thing, right?
Yeah, absolutely. So let's say rare earth supply chain is blocked. You have no rare earths, so you cannot make large magnets. If you cannot make large magnets, ASML's ability to make lithography machines is obstructed. If there are no lithography machines, you cannot make chips. And chips are what powers AI at the moment. So all the things that we are talking about, data centers, all the things we are talking about, okay, AI should do this, AI should do this, or I want to adopt AI. I cannot if I do not have the computing power. And computing power comes from chips. So it's chips that will be blockaded. And if chips are blockaded, AI stalls. There is no development of the AI, no further development of the AI, irrespective of how smart people are. If they do not have the compute power, if they do not have the data centers to store the information, AI stalls.
Right. So don't you think that, this industry is somewhere dependent on China and it is very risky to invest here?
It is dependent on China, but this is the thing. What if I make rare earth elements outside China by recycling magnets? Because
Right.
there are enough magnets outside China. So you have a lot of magnets already in India, you have a lot of magnets already in Vietnam, you have a lot of magnets in Europe, in US. What this company does is it collects those magnets, which are already going to waste, and recycles rare earth without needing China.
Great. Yeah.
Did I answer your question?
Yes. Thanks.
It actually bypasses China, and that is the strength of this company. That is why this company has attracted the biggest investors that you can think of: BMW, Upturn, Hitachi. These are all very, very big investors. Microsoft, and the company will remain in demand at least for the near time future.
Right. Thanks.
And this is why sometimes you have to make backward value chain, which is what I've highlighted here. This company actually does rare earth, but I have shown AI as the last end product. So you make backward, you walk backwards, whatever works for you. This is just an example. All right. Any other questions before we go on to team and governance again? Okay. So what I want to highlight is that my story is synced, is coherent. When I'm talking about technology, I'm relating it to value proposition. When I'm talking about value proposition, I'm talking about governance. And when I'm talking about governance, I'm talking about team. Okay. Everything in coherence, extremely important in a storytelling part. Can anyone explain me how does a VC, international or national, it does not matter, assess founder quality before assessing the product? And that's very important. Specifically if you're early stage venture, I would like to look what is the quality of the team before talking about the product. Anyone?
I think one of the main points would be, is a founder a first-time entrepreneur, or he's done it earlier.
Absolutely. Let's say if the founder is a first-time entrepreneur, and the product is amazing, what should I look in the team?
Experienced team members.
Absolutely. Okay, then we can go forward and go to the next slides. And I'll come back to it. Founder market fit. Let's say I'm a genetic scientist, which I am actually, but let's say I'm coming out of my academic journey and I haven't gone through what I have gone through. And I want to make a startup in recycling of plastics. Should I or should I not? And if you are an investor, should you invest in me or not? You should not, because my training is completely in a different part of the market and there's no founder market fit. It's extremely important to have that connect very clearly. Can this person deliver in a particular market or not? That's the first thing any investor look at. Because in the founders in a team, one person will definitely have a dominance, which means in dominance in terms of the shares, dominance in terms of the say, and dominance in terms of the strategic decision the company takes. That person should be extremely aligned with the market that this person has a venture in. Reference checks. How many of you know about the reference checks? How are they done? And why are they important? And what are those? Come on, this is the easy one. Reference checks are done to assess the character of a founder, or to see if a founder is what he or she is saying they are. How are they done? They are done by actually reaching out to the previous investors. How are they done? They are done by reaching out to previous colleagues of this person. A person can be great on a CV, on a paper, and let's say if I reach out to one of its past colleagues, and this colleague is like, oh my God, this person was always in arguments. This person could not navigate well in a team. This person has been aggressive towards his female colleagues, let's say. All of these are negative points. Good points, oh, this person has been able to resolve a lot of conflicts. This person has been able to deliver even in the toughest of situations. Extremely, extremely important. If I'm an investor, I will do a ref check. In certain cases, even very heavy ref checks, like asking for your electricity bills on where you live or asking for your passport. And depending on what kind of fund you are and what kind, so if a fund has DFIs are these big financial institutions. If a fund has DFIs as the LPs, the reference checks will be a lot harder. So if you are going to US or EU, be ready for those reference checks. Prepare for it. Transparency. As a team, are you transparent? Within the team, outside the team? What does it mean within the team? If I am reaching out to an investor and I have told one of my team members that he's a co-founder, but when I'm reaching out to an investor, I'm saying that this person is not a co-founder, just a founding team member. I'm not being transparent with both the parties. And this has happened to in one of my diligences. What happened was this. A person was presented to me as a founding team member, but not as a co-founder. And the day we were about to sign the shareholder agreement, also called as SHA, this person writes an email to the entire investor that were going to invest in that round that he does not understand what is going in the SHA, and he is not agreeing to a number of things what are in the SHA. Transparency. What did it do? The founder who was reaching out to investors, he was able to reach out to investors, he was able to attract investment, but because he lacked transparency towards his team member as well as towards the investors, he lost that investment. Extremely important to be transparent. The more transparent you are, the less things you have to worry about what can go wrong. In a team, specifically, no, not specifically, in both early stage as well as later stage teams, can I attract globally competitive talent? Which means, can I attract talent that can deliver on the milestones that I'm talking about in my investment ask? The more capable you are in attracting talent, the more proven you are in attracting talent, the more easy it is for the investors to go ahead and do the investment. It's an extremely important point. And the way you can showcase it is if you have already built a team in the past, if you have already experience of leading a team, or showcasing if you have already attracted, if you're a new team, if you have attracted already good amount of advisors which are strategically located. But it's an extremely, extremely important thing for any investor to look. Soft thing, but extremely important. Coming back to what we talked about earlier, is the team balanced? Do you have a founder which is extremely technologically relevant? But then if you only have a founder who is technologically relevant and you have no one to sell it, no one to make a financial model, and no one to actually go out and get commercial customers, the team is extremely lacking. The team cannot deliver on their commercial milestones. So this team is not the right team. Scaling up, which is a very important part. If this team is saying like they are going from a 100-ton capacity to a 10,000-ton capacity, or they are going from a certain amount of people, 100 people to 10,000 people for delivering a certain milestone, does the team have that experience to do this or not? Does the team combine science, engineering, manufacturing, and the business expertise? And if they do not, what is the plan for the scaling up? And that part has to be extremely clear. And that is scaling up also combines unit economics. If your unit economics today is 5 times the product, but you are only at lab scale and you're only producing something in kilograms, can you match the market prices if you are at 1,000 tons scale? And if you can, you have to show what are your cost drivers and how are those cost drivers going down or going up, or how are you managing those cost drivers as you scale up. So scaling up is a very important part. You need to showcase in terms of team, you need to showcase in terms of value proposition, and you need to showcase in terms of your technology. Knowledge concentration. Do you have different players playing different part of the team, or you have only one person who has all the technology and no one else? And what if this person leaves after I do an investment 6 months down the line, this person leaves? So depending on the knowledge concentration, I will add clauses in the SHA, like what is the vesting schedule? Can this person leave or not? If this person leaves, can he or she leave with their shares or not? And that becomes very important to showcase that you have a diversified knowledge concentration. You are not concentrated only in one person. If you can showcase it, great. Company's governance, extremely important. Again, the board members, the board seats, the board observers, information rights. If you do not have a board in place, how would you put a board in place? What would be the structure of it? Would you have an independent board member? Would you bring a larger investor as a board member? What is the limit for any investor to get a board seat? All of those things. The more clear you are at these things, the more the investor gets an idea that yes, you know how to govern a company. Communication and reporting expectations. All my companies report to me quarterly. If I'm sitting on the board seat, I get a board material 2 weeks in advance. Other than that, I have a monthly call with every single one of my portfolio company where I get all the challenges that they're facing, all the details that they're going through. The more you communicate, the more transparent you are, the better you are after you have received an investment for the follow-up round. And there will always be a follow-up round. Now, case study very quickly. I have this company that I invested in, and Nova Biochem, what they do is they convert one of the paper waste chemicals, which is black liquor, directly to the valuable chemicals without going through an intermediate stage, which most of the companies today go through. So technology-wise, they are amazing. They have very good strategic partnerships. However, when I invested in them, they had two founders, and this is the profile of those founders. One had a PhD in chemistry, another also had a PhD in chemistry. Can anyone tell me, is the team balanced? Was the team balanced when I invested in the company?
No.
No.
What should I have done, or what should have I done if I still wanted to invest in the company?
Check for their commercial knowledge, not just technical one.
Yeah. Okay, but now I know that there's no commercial knowledge in the team, but I still want to invest. What should I do?
I I think there should be milestones, even in terms of having right resources, and also SHA could have certain uh, terms which helps you to invest in that.
Absolutely. Within the 4 months that I invested in the company, I brought in a COO, a relevant CEO, who is an amazing operational person because there's a reactor is scaling up in the company, so he understands how the scaling up should go on. I'm also bringing in a chief commercial officer or a business person who can then take what the company does and start selling pilots for the company. So what we did is basically we brought in people, or we put in the SHA because we knew technology is so damn bloody good that we would still like to invest, but we put things in place that will that can allow us to push the startup to bring in the right people, and that's what we did. That's what team governance and international investors look for. Can they add value in this respect or not? And how rigid are you? If you say, "Look, okay, I'm completely technical, but I do not want to work with any other business person," yeah, it's hard for you to get an investment. But if you showcase the flexibility, it makes it easier. I stop here. This is me. I'm Saurabh, and I'm happy to take your questions in the last 3 minutes of this workshop.